Today is Sunday, July 31st, 2022, and the U.S. economy is currently sitting on $1.7 trillion in student debt, something that I'm not sure if we will be able to pay off as a country, and a lot of money. There are two main types of student loans available for Americans. The first kind is U.S. government-backed student loans, which are known as federal student loans, and then there are student loans that are backed by banks or non-government institutions, which are known as private student loans. It's important to be careful and do your extra due diligence when taking a private student loan because some institutions are shady and claim that they are offering them through the federal government when in reality they themselves are giving the loan out. This can lead to problems down the road. Let's start by going over federal loans. Like I said, federal student loans are backed by the U.S. government, and I like to recommend them for people that are taking student loans as the first choice. Federal student loans tend to be a lot cheaper for individuals and come with more benefits than private student loans. Some of the benefits from federal student loans include fixed and lower interest rates, the ability to borrow money without a cosigner, repayment plans that start 6 months after you leave college, so they give you a little bit of time to get your feet wet and make some money. They also have income-driven repayment plans, so that means they will take a look at what your income is after college and then help you with a plan based on how much income you're making, so all your money is not going to the loan interest. There's also a possibility that they will be forgiven. I know that if you work certain professions such as being a teacher, or if you work a public service for your municipality, they give you tons of benefits but can also forgive the loan because you're working for the government. They give and take. So the first student loan I'd like to talk about is the subsidized Stafford loan, which are available to undergraduate students with a demonstrated financial need. That means that they literally cannot go to college without a student loan. The best part about this loan is that while you're enrolled in college and for 6 months after, you do not have to pay any interest on the student loans. This comes to a huge cost saving for those students in financial need. The second federal student loan is the unsubsidized Stafford loan, and these are available to undergraduate and graduate students regardless of your financial need. Unlike the subsidized Stafford loans, you will need to pay all the interest that is accrued back on your loan even while you're in college, or the interest will be capitalized. That means it gets added to the loan balance. The third federal loan is the Federal Direct Plus loan. This one is available to graduate students and parents of dependent undergraduate students. These loans are not subsidized, so the interest will start accruing as soon as the payment or as the loan is fully dispersed. The good part about this loan is that repayment can be deferred while the student is enrolled in college and up to 6 months after graduation. The fourth federal student loan is the Federal Direct Consolidation loan. This loan allows people to combine multiple federal student loans into one loan without losing any of the benefits that the federal loan comes with. So this can be a great value add if you're looking for multiple degrees or just want to continue your education. I would recommend using a consolidation loan when you're trying to streamline the repayment, or if you just want to switch loan servicers. And then there are the private student loans, which are from banks, credit unions, or state loan agencies that are not tied to the federal government. These can vary from lender to lender, and it all depends on who you're taking the loan from, which is why it's better to take a student loan from the federal government because you know that they have multiple options available and that the benefits tend to be much more than the private loans because the federal government really wants us to get our education. It's important to understand that private student loans can come with either fixed or variable interest rates. Stay away from the variable interest rates because if the rate changes against your favor, then you're going to be owing a lot more money than you originally planned, and it could be a lot more money than you can afford to pay off. So you may be wondering, how does the interest work on student loans? Well, keep in mind, you're not just paying back the amount you borrowed, you're paying back the interest that's tied to the loan as well. How much you pay in interest depends on a number of factors, whether your loan is subsidized or unsubsidized, the the interest rate on the loan, the amount you borrow, and the loan term. For example, if you graduate with a $10,000 loan tied to a 5% interest rate and pay it off in 10 years, you will pay $2,728 in interest over those 10 years. Student loan monthly payments include both payments to reduce the principal balance and interest payments. So the total amount repaid will be $12,728. That includes the $10,000 principal and the $2,728 interest. Loan payments are applied to the loan balance in a particular order. First, the payment is applied to the late fees and collection charges. Then, the payment is applied to the interest that is accrued since your last payment. Finally, the remaining money is applied to the principal balance. So if you pay more each month, you will make a quicker progress in paying down your debt and hopefully paying less in interest. Now there's a secret hack to allow you to pay less in interest. You can reduce the amount you pay in interest by making extra loan payments and charging that extra payment to the interest balance. So how do we apply for student loans? Well, the application process for federal loans and private loans is a little different, but remember, you should only apply for a private student loan once you've tried all of the federal student loan options. To apply for a federal student loan, you'll need to file a free application for federal student loan aid. This information can be found just by typing in federal student loans on Google. Your college will send you a financial aid offer. This will include the details on how to accept the loan, and then you'll need to sign a master promissory note. Now, to apply for a private student loan, you don't need to file through the FAFSA. You'll need to apply for a loan with an individual lender. So the lender is going to be checking your credit score, and it will often require a creditworthy signer because when you're 18 years old, you don't have much credit built up. So how much can you borrow in a student loan? Well, lenders usually look at the institution that you're going to and only give you the amount that you literally need to graduate college. But the amount that you can borrow depends on the type of loan. For federal loans, your college will determine the amount of money you can borrow, and there are some limits. So for the undergraduate federal direct Stafford loans, the borrowing limits are from $5,500 to $7,500 per year for dependent students, and then $9,500 to $12,500 per year for independent students. Graduate level student loans allow you to borrow up to $20,500 per year, and then $40,500 per year for medical students. The maximum amount that private loans allow you to borrow vary from lender to lender, but all lenders typically max you out at the amount that you need to graduate college. They don't give you any more than that. So that's pretty much all I got for how student loans work. I really hope this gave you guys more of an understanding about how these loans work. Maybe it gave you guys some inspiration to get a student loan or to avoid getting a student loan. And if you did learn some things, please throw me a like, throw me a subscribe, share it to one of your buddies that could be taking a student loan, and catch you guys next time.